Hey everyone, welcome back to Corporate Decoder. Today, Credit Suisse Opportunity Funds just filed their N-CSR report for the period ending April 2026, and I am seeing some really interesting breakdown of their investments. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a glimpse into where these funds are putting their money and what that might mean for investors. So this is a report that registered investment companies have to file with the SEC. It is basically a shareholder report, and it tells you what is going on with the company's investments. We are looking at the Credit Suisse Opportunity Funds, and specifically we're going to dive into the Credit Suisse Floating Rate High Income Fund and the Credit Suisse Strategic Income Fund. The filing has a lot of parts, but what we really want to focus on are the financial details and the investment breakdown. This is where we can see what the funds are actually invested in and how that might be performing. Let's first look at the Credit Suisse Floating Rate High Income Fund. This report covers the 6 months from the 1st of November 2025 to the 30th of April 2026. The main goal here is to provide investors with information about the fund's performance and holdings. Now, let's talk about costs for a hypothetical $10,000 investment in class of shares. The costs for these 6 months were $48, which is 0.95% of that investment. For Class C shares, it was $85 or 1.70%, and for Class A shares, it was $35 or 0.70%. So you can see the difference in costs depending on the share class, which is pretty standard. Looking at the big picture numbers for the floating rate high income fund. Total net assets were a huge $1,513,478,002. That is over $1.5 billion. The fund holds 468 different investments and the portfolio turnover rate was 16%. A lower turnover rate means the fund managers aren't buying and selling assets too frequently, which can sometimes lead to lower costs and a more stable strategy. Their objective is to seek high current income, and secondarily, capital appreciation. This means they are primarily looking for investments that generate a good amount of income, and then they also want the value of those investments to go up. This is where it gets really interesting. How are they achieving that high income objective? Well, a massive 86.6% of their investments are in bank loans. Bank loans, especially floating rate ones, can offer good income, but they also come with their own set of risks. They also have 5.4% in short-term investments, 4.0% in corporate bonds, 2.6% in asset-backed securities, and 1.3% in common stocks. Notice that preferred stock and warrants make up 0% of their investments. This tells us they are heavily focused on loans and less so on owning company stocks directly or other types of securities like warrants. Now, let's look at the credit quality of these investments using S&P ratings. A big chunk, 21.8%, is rated B, and another 20.2% is rated B. Then you have 14.0% rated B together. These represent over 56% of the portfolio in B-rated securities, which are considered below investment grade. This means there is a higher risk of these companies not being able to pay back their debts. We also see 7.7% rated BB, 8.6% rated B, and 4.4% rated BB. These are in the BB range, which are still considered speculative. Around 1.7% is rated CCC, and another 1.7% is rated CCC, with 5.5% rated CCCI. These are even riskier. There is also 7.3% that is NR or not rated by S&P. In total, about 93.3% of the investments fall into these rated categories, with the remaining 6.7% in equity and other. This breakdown clearly shows a fund that is comfortable taking on significant credit risk to achieve its income objectives. Let's zoom into the actual investments. Most of the portfolio is indeed in bank loans. For example, under advertising, we see MH-I LLC with a loan of over $6.7 million at a rate that is tied to SOFR plus 7.902%. This is a floating rate loan, meaning the interest payment can change. They also have another MH-I LLC loan for over $6.5 million. Under Aerospace and Defense, there is Aircom Corp, LIC with a value of over $381,000 and another loan of over $7.8 million. Amentum Holdings Inc. has a loan over $8.6 million. Arcline FM Holdings LLC has a loan of over $2.5 million. Atlas CC Acquisition Corp. has 2 loans totaling over $2.1 million. Blériot US Bidco Inc. has a loan of over $2.5 million. Brown Group Holding LLC has multiple loans totaling over $14.9 million. Cassie International Inc. has a loan of over $1.8 million. KBR Incorporated has a loan of over $1.8 million. And KKR Apple Bidco LLC has a loan of over $6.3 million. Peraton Corp has 2 loans worth about $364,000 and over $6.6 million. Transdim Inc. has several loans totaling over $16 million. In air transportation, American Airlines, Inc. has a loan of over $7.5 million, and United Airlines, Inc. has a loan of over $4.3 million. For auto parts and equipment, AutoKineton US Holdings, Inc. has a loan worth over $6.3 million. Bellin Finance 2019 LLC has a loan of over $4.4 million. Clarios Global LP has two loans totaling over $9.8 million. CWGS Group LLC has a loan of over $3.9 million. Garrett LXI Sal has a loan of over $2.2 million. Jason Group Inc. has a loan of over $2.4 million. Les Schwab Tire Centers has a loan of over $326,000. Open Lane Incorporated has a loan of over $593,000. And RVR Dealership Holdings LLC has a loan of over $2.6 million. It is clear from this list that the fund is heavily invested in bank loans, and many of these companies have credit ratings that indicate a higher level of risk. Back to the fund overview, the total net assets are indeed over $1.5 billion, reinforcing the scale of this fund. Looking at the statement of assets and liabilities, we see the investments at value are $1,543,894,947. This is higher than the total net assets, which is common due to leverage or other factors. Cash is about $1.4 million. There is also significant amounts for receivables and payables related to investments, which is normal for a fund like this. Under liabilities, payable for investments purchased is over $58 million. This is typical as funds buy and sell securities. Now, the statement of operations tells us about the fund's income and expenses for the 6 months. Investment income, mainly from interest, was over $70 million. Expenses were around $7.5 million, but after waivers and reimbursements, the net expenses were about $6.4 million. This resulted in a net investment income of over $65 million. However, the fund also saw a net realized loss from investments of over $24 million and a net change in unrealized depreciation from investments of over $9 million. This pushed the total realized and unrealized loss from investments, foreign currency transactions, and forward foreign currency contracts to over $35 million. Despite the income, the overall net increase in net assets from operations was positive at around $29.5 million. On the statements of changes in net assets, we see the capital share transactions. Proceeds from sale of shares for Class I were over $207 million, while redemptions were over $686 million. This means a net decrease in net assets from share transactions. The financial highlights give us a per share view. For a Class I share, the net asset value at the beginning of the period was $6.17, and it ended at $6.06. The total return for the 6 months was 1.90%. The ratio of net expenses to average net assets for Class I was 0.70%, which is quite reasonable for a fund like this. Now, let's quickly switch to the Credit Suisse Strategic Income Fund. This fund also covers the same period, the 1st of November 2025 to the 30th of April 2026. For Class A shares, the costs on a $10,000 investment were $52 or 1.04%. For Class C, it was $89 or 1.79%. And for Class I, it was $39 or 0.79%. These are slightly higher than the floating rate high income fund, but still in a similar ballpark. Total net assets here were over $1.1 billion. They hold 581 investments with a portfolio turnover rate of 33%. This turnover rate is higher than the floating rate high income fund, suggesting a bit more active trading. This fund seeks total return. This is a broader objective, meaning it aims to deliver both income and capital appreciation, not prioritizing one over the other as much as the floating rate fund. Interestingly, this fund has a different primary focus. Corporate bonds make up 50.5% of the investments, followed by bank loans at 40.0%. Then there are asset-backed securities at 5.4%, short-term investments at 3.9%, and a small 0.2% in common stocks. Again, 0% in preferred stock and warrants. So, while both funds invest in bank loans, the Strategic Income Fund is more balanced between corporate bonds and loans, and also has a larger portion in corporate bonds. For credit quality, we see 0.9% rated AAA, which is great. Then we have 18.4% rated B, 14.4% B, and 12.3% B. That is over 45% in the B categories alone. We also see quite a bit in the B range, around 30%. There is 2.2% BBB and 0% BARD. Then we have 0% in CC, 2.8% CCC, 0.6% CCC, and 6.6% CCCC. The NR or not rated category is 4.9%. The subtotal for rated securities is 95.9% with 4.1% in equity and other. This fund also takes on significant credit risk, though perhaps a slightly broader distribution of ratings compared to the floating rate fund. Looking at the detailed investments under corporate bonds, we see RR Escrow Issuer LLC with over $2.4 million and Momentum Holdings Inc. With over $4.4 million, Bombardier Inc. has multiple holdings totaling over $1.5 million. Cassie International Inc. has a holding of over $5.4 million. Science Applications International Corp. has over $2.4 million, and Transdig Inc. has several holdings totaling over $8 million. Similar to the other fund, this also manages over $1 billion in assets. The statement of assets and liabilities shows investments at value at over $1.18 billion. For the 6 months, investment income was about $44.6 million. Total expenses after waivers were about $4.9 million. Net investment income was around $39.7 million. However, there was a net realized loss from investments of over $22 million and a net change in unrealized depreciation from investments of over $8 million. This led to a significant net realized and unrealized loss of over $30 million, resulting in a net increase in net assets from operations of about $8.8 million. For a Class I share, the net asset value went from $9.42 to $9.18. The total return for the 6 months was 0.83%. The net expense ratio for Class I shares was 0.79%, which is in line with expectations. What is the story here? Both funds are investing heavily in high-yield debt, particularly bank loans and corporate bonds. This means they are aiming for higher income, but also taking on more risk, especially credit risk. The Strategic Income Fund is a bit more diversified in terms of asset types between bonds and loans, and has a slightly higher portfolio turnover. The financial statements show that while the funds generate good investment income, market fluctuations, particularly in the value of their investments and forward currency contracts, had a significant impact on their overall performance during this period. The net realized and unrealized losses, especially in the Strategic Income Fund, highlight the challenges of managing a portfolio with this level of credit risk in today's market. When you look at the management fee structure, especially the expense limitation agreements, it is clear that the manager is trying to keep costs down for investors, which is a positive. However, the underlying investment strategy itself carries inherent risks that investors need to be aware of. The focus on bank loans and below investment grade corporate bonds means these funds are not for the risk investor. Interestingly, the filing includes a detailed explanation of why the Board of Trustees approved the renewal of the investment management agreement with UBS Americas LLC. They looked at the nature and quality of services, the manager's profitability, economies of scale, and other benefits to the manager. They also compared the fund's fees and expenses to peers, finding that while contractual management fees might be in the middle range, actual expenses after waivers were quite competitive for the floating rate high income fund. For the Strategic Income Fund, the contractual management fee ranked higher among peers, but actual expenses were more competitive. Fund performance was also reviewed, with the Strategic Income Fund showing strong long-term performance in the top quintile, in some periods despite shorter-term performance that varied. This process shows a thorough review by the board to ensure the management agreement and fees are fair and reasonable for the shareholders. In conclusion, these filings reveal funds that are actively pursuing higher yields through riskier assets while they generated income. The overall financial performance was impacted by market volatility and realized unrealized losses. Investors in these funds should understand the significant credit risk involved and monitor the fund's performance closely. The management's efforts to manage expenses and the board's oversight provide some comfort, but the core strategy remains focused on higher risk, high reward investments. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.